Good afternoon, everyone, and thank you so much for joining the webinar today. The point of today's call is to familiarize yourselves with the January report that ITR Economics has produced for MTI. It's also to review our definitions and methodology so that you know how to read the report well and be able to derive the most information and the most value from the report that MTI produces for you. My name is Alex Cherosovsky, and I am the ITR Economics Senior Analyst that is responsible for producing MTI's quarterly report. As I mentioned, I think it's important for us to set the stage with a little bit of an introduction to our definitions and methodology so you understand the terms and the charts that I'm going to share with you throughout this presentation. So what I wanted to do first is to establish a little bit of credibility for ITR Economics. Whenever you are dealing with economic data, I think it's really important to be able to trust the numbers that are being shared with you, especially when it comes to things like sales forecasts. At ITR Economics, we take great pride in the accuracy of our forecasting capabilities. Over the 30-year time frame that we've been tracking our own accuracy rates, we have a 94.7% accuracy for macroeconomic forecasts. In this particular chart, I wanted to share with you the forecast results for 2015. As you can see, across the board, we really outdid ourselves. The way to read this chart is to look at the name of the macroeconomic series in the left-hand column. The second column, called duration, shows you how long that forecast was in place when we measured our accuracy rating. The third and fourth columns show the forecast as it was in the beginning when we set it in place, and the actual results through the month that you can see in the following column, whether it's December or November. And finally, the accuracy rating in the final column. As you can see, for series such as US GDP, industrial production, China industrial production, and various microeconomic series within the US economy, such as housing, retail sales, or employment, we had an accuracy rating of over 98%. The particular emphasis should be on our 98.6% rating for Chinese industrial production, which is a series that is notoriously difficult to forecast. So I take great pride that 22 months out, we were able to deliver a forecast with an accuracy of that 98.6%. And again, the point of this chart is really to establish our credibility and show you that we are a reliable source of information when it comes to macroeconomic forecasting. The second thing that I wanted to do is to review our methodology with you so that you're familiar with some of the terms and some of the figures that you'll see in the upcoming charts. So whenever we look at data, it could be a company's sales data or the performance of a particular vertical market or perhaps even an entire country's economy. We look at it on a monthly basis. So in this particular case, you see the data for a particular company from March 2014 to February 2016. And when we're looking at sales data in this manner, it's very difficult to tell any kind of major significant trends that will have developed. So what we do is we first calculate something called the 3 MMT. That's the 3-month moving total. And we do that by simply adding the last 3 months of data together. So we take December, January, and February, add it together to calculate the 5.3 value for 3 MMT. We then compare that data to the same period 1 year ago to calculate what is referred to as the 312 rate of change. That's the quarter over same quarter last year growth rate. When you look at the data on a moving total basis, as in the 3 MMT, you can see that this particular data series is clearly growing over time. When you add in the inference from the 312 calculation, you can see that although the series is growing, the rate of growth is actually decelerating. Once we've done this on a quarterly and a quarter-over-quarter basis, we then do the same thing on an annual basis. So first, we take the last 12 months of data and add it all together to calculate the 12 MMT, the 12-month moving total. We then compare that period to the same time frame 1 year ago to calculate the 12/12 rate of change. This is essentially the annual growth rate for this particular series. So again, you can see the clear rising pattern developing in the data in the 12 MMT column, but clearly we see an issue has developed here because the growth rate has essentially been cut in half over the last 6 months. That's what we can derive from the 12-12 column. And it's important to note that there is a relationship between the 3-12 and the 12-12 rate of change. When the 3-12 is above the 12-12, that means that further rise in that annual growth rate is coming. When the 3-12 is below the 12-12, that means that the 12-12 rate of change will decline in the coming months and quarters. Once we've had a chance to analyze the data this way to figure out the moving totals and the rates of change, we can then tell what phase of the business cycle this particular company, or it could be an industry or a country economy, is in. There are really 4 phases to the business cycle. 2 of them are below the zero line, and 2 of them are above zero line. The phases that are blue and red indicate contraction. The phases that are green and yellow indicate expansion. The first phase is called phase A, and that's a phase of recovery. That's when the annual sales for this particular series are below year-ago levels and the rate of decline is slowing or getting closer to that zero line. The second phase is phase B. That means B is for best, so it's the best phase of the business cycle. And that's when annual sales are above the year-ago levels and are growing at an accelerating pace. Phase C is where most of the U.S. economy is in right now. That represents slower growth. That's when sales are above last year, but the rate of growth is slowing. And phase D is recession, when your sales are below year-ago levels and are declining at a rapid pace. It's important to know what phase of the business cycle you're in because that will drive the type of strategic decision making that you need to do to turn your business around if you're in decline or to continue that growth pattern if you are in fact expanding. Once we've calculated the rates of change and figured out what phases of the business cycle the data is in, we then look for leading indicator series. This chart shows a great example of the relationship between a company's data, and it could also be an industry or a country, and its leading indicator. The blue line, which represents the indicator series, is really visually comparable to the green line, which represents the company sales in this example. You can see that the peak in March 2010 corresponds to the peak in March 2011 on the company data. What that tells us is that their leading indicator series has a 12-month lead time to the company sales. We can then use this information alongside the latest data from that leading indicator to offset it by the timing relationship and basically have a glimpse into the future. So you see this declining pattern in the blue line, essentially decelerating growth. What that tells me as an economist is that the green line, the company sales, will likely continue to face negative pressure, and there is more than likely going to be further decline over the next 12 months. Let's take this principle in practice. The orange line in this chart represents the ITR leading indicator. This is a proprietary indicator that we've developed that represents all of the U.S. economy. It has sectors like the stock market, industrial production, it has retail sales, automotive, food and beverage sales. So it's a holistic perception of what's going on in the U.S. economy right now. And it has a leading relationship to U.S. industrial production. In fact, it leads industrial production by 9 to 11 months. So when we offset it by that timing relationship, we can tell that the declining trend in the ITR leading indicator suggests that the U.S. economy will likely decelerate further in the months to come. In fact, the fact that this is just above the zero line tells us that there is likely significant headwinds facing the U.S. economy right now. So when we look at U.S. industrial production, we can tell a couple of things. By looking at the chart on the left-hand side, we can see that industrial production is in fact growing. It's not only growing, but it's significantly above the pre-recession levels of 2008-2009. We are currently 1.3% above the year-ago level, but the U.S. Industrial Production Index is in phase C, representative of decelerating growth. You can see that very clearly by the fact that this blue line, which represents the 12-12 rate of change for industrial production, is in a declining pattern. Our forecast is that the headwinds that I mentioned earlier, things like the strong US dollar, things like low commodity prices, certainly including oil, things like weak emerging market growth, are really significantly affecting this particular barometer of the US industrial economy. In fact, our forecast calls for a contraction in the first, second, and third months of this year, and a return to growth only in the fourth quarter of 2016, when we'll essentially eke out 0.2% expansion over 2015 levels. So in other words, we're expecting 2016 to be essentially flat for US industrial production relative to 2015 levels. The good news is that in 2017, we are expecting this series to rise quite a bit. In fact, we're expecting expansion of 2.7% for US industrial production in 2017 relative to this year. Non-defense capital goods new orders is another series which I believe is very important to MTI and is a leading indicator to your business. This particular series represents the business-to-business activity in this country. And what you can tell by looking at this chart, which shows the rates of change in the top portion of the chart and the 3-month and the 12-month moving totals in the bottom portion, is that this series is actually in recession right now. On a year-over-year basis, as represented by that blue line, the 12/12 rate of change, the series is down 3.9% relative to same time last year. The good news, the silver lining to that cloud, is the fact that the 3/12 rate of change, the quarter-over-quarter growth rate, has now upward past that blue line and sits at minus 3.5%. What that tells me as an economist is that there is a cyclical low that's going to happen imminently for the new orders 12/12, the business-to-business activity annual growth rate, and that it will turn around in the next several months and start heading upwards, first through a period of recovery and then to a period of growth in 2017 and beyond. It's important to note that this particular series is measured in dollar terms. So you can see that it's been declining really for most of 2015, and I believe a large part of that decline has been the weakness in commodity prices. Everyone knows about the fact that the price of oil is down essentially 70% relative to its early 2014 high of over $100 per barrel. What most people don't realize is that all commodities have been battered during this time frame. Things like steel, copper, aluminum, the most used industrial metals are all down double digits. In the case of steel, the decline is 37% year over year. Copper is down over 19%, and aluminum is down more than 13%. And what this has an effect on business-to-business activity is it really affects the dollar value. The reason for that is because if you're making a machinery, for example, a piece of industrial equipment, and steel and copper are your major input costs, your buyers know the fact that you're paying a lot less for these commodities right now. And so as a result, they're expecting you to pass on those savings in the form of lower selling prices. And so your volume of activity might not necessarily be in contraction, but your revenues resulting from the sale of that piece of equipment certainly are feeling the pain of these low commodity prices. And that, again, is why we're expecting the decline in the 12-month moving total to continue until those commodity prices start to stabilize and recover, which we're certainly seeing in the case of things like steel prices. We've seen some mild price increases get put into place since mid to late December timeframe, and those seem to be holding. So we're hoping that that is an indicator that we've reached the bottom with these commodity prices and that they will start trending back up slowly over the course of 2016. But in the meantime, this series is going to continue to remain weak as a result of those low oil and commodity prices. I wanted to list the updates at itreconomics.com email here for you. If you want to have any questions for me, either during or after this webinar, certainly feel free to send an email to that account and reference the webinar that I'm holding today. And I'll be more than happy to answer the questions that you have regarding our methodology, our definitions, or anything else related to the economy and our outlook for 2016. The next step that I wanted to do is to actually go through the MTI report that I produced for the first quarter of 2016 and that you will have hopefully received early this month. The way that the report is structured is you have your title page, you have the table of contents on the second page, and the third page lists and reminds you of those definitions, the 3 MMT, the 12 MMT, the rates of change definitions that I covered with you today, as well as what the phases of the business cycle represent. The real meat of the report starts on page 4. So I wanted to review that with you in a little bit more detail. Page 4 is probably the most important part of this report because this is where we show you our forecast for MTI total sales based on the data that we received from your organization. So the way that you read this chart is it has the quarter on the first row. So starting with the first quarter of 2016, going all the way through to the end of 2018. The following row has the 3-month moving total in terms of dollar values and the 3/12 rate of change. Again, that quarter over quarter growth rate. The following row has the 12-month moving total, and the final row is that very important 12/12 rate of change. We've also taken the step to color code this for you to match the business cycle phase that the data series is in given that quarter. So the way that you would read this is that you can tell that the series is currently in recession and it will remain in recession through the second quarter of 2016. For the following 3 quarters, it will enter a period of recovery before growth emerges in the second quarter of 2017 and goes through the end of the year. And then you will enter a period of decelerating expansion in early 2018 and finalize the year on slightly negative performance at minus 0.3%. And that really leads to our expectations of a very mild macroeconomic recession in the US late 2018, early 2019 timeframe. Another way to read this is by looking at the year-end values. So essentially what we're saying is that MTI total sales will finish this year down 5.7%. They will grow 7.7% by the fourth quarter of 2017, so year-end 2017. And then that slight contraction will occur late in 2018. The 2 charts below show the 12-month moving totals. You've got the bars representing the historic performance, and the yellow bars here on the right-hand side represent our forecast for the 12 MMT. The dark blue line that you can see shows you the 3-month moving total. On the right-hand side of the chart, you can see the year-over-year growth rates, the rates of change, in other words. So the 3/12 growth rate is the dark blue line. The light blue line is the 12/12 rate of change. And these bars here represent the forecast for the 12/12 growth rate. Below the charts, you can see some key highlights of the analysis. Again, those year-end values you can see listed on the right-hand side here. You can see that for the last 12 months, the annual trend of MTI total sales sits at $885 million. The series is currently in recession, phase D, so clearly indicating that the industry and your organization is going through a difficult time right now. And you're currently down 5.5% versus the year ago level. There's also some additional commentary at the bottom of the page that gives a little bit of extra analysis related to these series. The following page shows you the monthly data that we received from ITI. So it's a historic perspective of what's going on. Basically, you have the data starting in January of 2015 all the way through the end of the year. Similar kind of data series are represented. You've got the monthly sales in the first row, the 1/12 rate of change, or the month over the same month last year growth rate. So that means that January 2015 was 5% above January of 2014, and so on. You have the 3-month moving total and the 3/12 growth rate, the 12-month moving total and the 12/12 rate of change. And again, it's color-coded to the different phases of the business cycle. So when I look at this, I can easily tell that the first 2 months of 2015 were good. I was in phase B. I then entered phase C for the following 6 months. when my growth rate decelerated, and the last 4 months of 2015 I spent in recession with that year-over-year contraction getting significantly higher month over month over month. Here below is just a visual representation of the monthly reported data from MTI, showing you which months of the year tend to be the highest and which ones were the lowest, certainly in the case of 2015. The following 2 pages are focused on the leading series that we believe play a large role in driving MTI sales performance. So the first one is U.S. industrial production. You can see again the annual trend for the index at 107.1. It's currently in phase C, slower growth, and is up 1.3% on a year-over-year basis. U.S. industrial production data trends, which is the 12-month moving average, in this case it's an average, not a total, because it is an index value, is shown in the yellow for the historical numbers, and in blue it is presented our forecast for U.S. industrial production over the next 12 quarters, essentially through the end of 2018. On the right-hand side, you can see MTI total sales compared to U.S. Industrial Production Index. And I wanted to zoom in on this very quickly to explore it in a bit more detail. Basically, what you have is the 12/12 rate of change for MTI sales, along with our forecast for your business, represented in the yellow, and the 12/12 rate of change for industrial production and its forecast represented in the blue. The reason why this series is such a good indicator for what's going to happen to your business is because the rates of change follow each other through the business cycle, highs and lows, very consistently. You can see the trough that's represented by the recession was certainly felt both by industrial production and MTI. We had a nice bounce back period in the 2010, 2011, 2010, 12 timeframe. Both series performed above average. Then we have these lows and highs that correspond in the years since the recovery. And again, the forecast is based on the profile of what we expect industrial production to do. So you can see our expectations for a low in U.S. industrial production in the third quarter of 2016 corresponds essentially to the low for MTI sales in the second or third quarter of this year, and then a period of rise will ensue based on the rise in industrial production. Below the charts, you have some commentary about the index itself with some additional insights and the year-end values for industrial production, it being essentially flat this year, rising by 2.7% in 2017, and then slowing in its rate of rise to 1.1% by 2018. The next page has a similar look at non-defense capital goods new order series, again representing that business-to-business activity. You've got the new orders moving total data, historic perspective in the yellow, our forecast for new orders data in blue, and again a similar look showing the MTI sales in the orange line and the series and forecast for new orders data in the blue line. You can see again highlighting that new orders business-to-business activity is in recession right now, down 2.7% at the time of this report's publication, but as you saw in the slides earlier, it's actually ticked down to lower than 3% or more than 3% contraction as of the latest point of data that we have available right now. Again, a similar profile for the analysis, some additional commentary on new orders and business-to-business activity in general, as well as year-end forecast for 2016, 2017, and 2018 listed here at the bottom of the page. So that brings the report to a close. Again, I would say that the most valuable portion of this report can be found on page 4, which is showing you our forecast for MTI total sales, along with expectation of what phase of the business cycle you're going to be in given that quarter. This report will be delivered to you every 3 months, and so I certainly encourage you to reach out to MTI. If you haven't gotten a copy of the January report, I encourage you to reach out to me at ITR Economics anytime you have questions about the report or just want to ask anything related to the U.S. economy overall. And with that, I thank you very much for your time, and certainly happy to answer any questions that you might have. Please do send them to that updates@itreconomics.com email address. Again, this is Alex Cherusovsky, your senior analyst with ITR Economics. Thanks a lot for your time this afternoon and have a great day.